Ladies and gentlemen, dear participants, it is my pleasure to welcome you all to this 16th thematic session of the 2022 Global Platform for Disaster Risk Reduction on transformative financing option to build resilience. I would also like to extend a warm welcome to everybody joining us online from around the world. My name is Chira Gedegbe. I develop expertise in media and communication, and I come from Benin. This afternoon, ladies and gentlemen, we will discuss and explore the implementation and scale-up of innovative market-driven product and option for the financing of resilience. This year's global platform is particularly important as it will provide input to the midterm review of the Sendai Framework, which will guide effort to accelerate action over the remaining 7 years. This session is particularly critical as society continues to bear increasing costs from natural hazards given population growth, the geographic concentration of economic and infrastructural assets in vulnerable areas, and the effects of climate change, which are accelerating exposure to potential losses. Resilience required a layered financial strategy, bringing to bear all sorts of financing, and risk prevention projects need to draw on all potential beneficiaries for funding. Traditionally, and in most developing countries, financing for disaster risk reduction is heavily dependent on resources from bilateral and multilateral cooperation. However, based on recent reports, for every 100 USD spent on total development aid between 2010 and 2018, disaster risk reduction received as little as 47 cents. We must move beyond these traditional financing mechanisms, which are limiting to more innovative financing model. Public-private partnership remain a good practice that need to be further strengthened. Core benefits, bankability, and pipeline of resilient-oriented projects supported by strong commitment of national government could drive market interest and foster stronger partnership between public and private sector. However, this needs to be aligned with national and local disaster risk reduction strategies and serve as a catalyst for domestic, public, and private sector investment that reduce rather than create new disaster risks for the communities. National disaster risk reduction financing strategies and instruments can, ladies and gentlemen, change the way money is spent and contribute to a more efficient and use of resources. They can bring together the optimal mix of financing from all available domestic and international, public and private sources, including development cooperation in all its forms. This includes integrated national financing framework and national development cooperation plans and relevant regulation and standard for risk-informed investing. Today, we are here to learn more about innovative financing models such as blended finance and investing, which have emerged as tools for addressing risks and encouraging the private investment that can transform people's lives and contribute towards Sendai Framework. But before we start, ladies and gentlemen, allow me to outline a few housekeeping matters to guide our session this afternoon. If you're watching online and then you wish to follow the session in one of the 6 UN languages, you can select the language channel in the box to the right of the video window. It is very important that you mute the audio from the video player, otherwise you will be hearing the original language plus the interpretation. There is a short video on the reception page that can help you. explain how to do this. For comment and questions to our panel members, please use the Slido application. We will have a Q&A session toward the end of this session, and then you'll be able to ask questions. In room, participants can connect on slido.com using their mobile phone and insert the code that is shown on the screen, is shown on the room screen. For those following us online in Hopin, please access the tab Pool and Q&A on the right-hand side menu. If you are in the room and are unable to use the Slido, please raise your hand and room support staff will assist you. If you are in Hopin and are unable to use the Pool and Q&A tab or any other Hopin feature, please contact the online support team via the chat box. Now it gives me great pleasure to introduce our speakers this afternoon. We have on my right Mr. Didier Trebuc, who is the UN Resident Coordinator for Barbados and the Eastern Caribbean. And he is the UN Resident Coordinator for the Multi-Country Office of Barbados and Eastern Caribbean, and has more than 19 years experience in the areas of sustainable development, international affairs in Latin America, the Caribbean, Asia, and he is a great advocate for policy changes to reduce poverty and foster sustainable economic growth. He leads a team of development practitioners and promote diversity of thoughts and innovation. We will definitely learn a lot from him this afternoon. My second panelist is joining us virtually. This is Dr. Charlotte Benson. She is the Unit Head for Disaster Risk Management for Sustainable Development and Climate Change Department at the Asian Development Bank. Dr. Charlotte is, as I say, Unit Head for Disaster Risk Management at the Asian Development Bank, and she has over 30 years experience working on economic and financial aspects of disaster risk management in development countries. Her work at the Asian Development Bank includes the development and coordination of disaster risk management policies and strategy, and support to ADB's operational department in designing and implementing disaster risk management project and program, include disaster risk financing initiative. We have on my right Mr. Tumasi Blair. He is the lead negotiator for Sustainable Development Alliance for Small Island States. Mr. Blair is the New York team lead for Antigua and Barbuda's chairmanship of the Alliance of Small Island States and lead negotiator for sustainable development and macroeconomic policy issues. He has over 10 years experience in multilateral affairs and diplomacy. Over the decades of his diplomatic career, he has functioned as lead for CARICOM, OASIS, and the Group of 77 in China on international resolution on external debt, international financial system, international tax matters, financing for development, the SDGs, United Nations Convention on the Law of the Sea, the Samoa Pathway, and other humanitarian affairs revolution. Mr. Blair is the current lead for OASIS regarding the creation of a multi-dimensional vulnerability index as mandated by the UN General Assembly. My last panelist is also joining us virtually, Mr. Don Evenson. He served as Edmonton 35th mayor from 2013 to 2021 for a guiding leadership principle to make things better for the next generation. This long-termism is now embedded in Edmonton's Smart Growth City plan, City Council's energy transition strategy, and first in Canada carbon budget, and Airmon's nation-leading citywide flood mitigation strategy. In addition to this role with cooperators, Don has accepted as an appointment as a School of Cities Canadian urban leader at the University of Toronto. He is also ramping up a public policy advisory practice working on climate, housing, regional governance, and civic innovation projects with like-minded clients, including operators, co-operators. Ladies and gentlemen, today's first issue will help us understand 2 points. First, to Mr. Trebik, in what way are current financial models contributing or not to resilience? That should be my first question to you.
Thank you, moderator. Good afternoon, everyone. It's my pleasure and my honor to join this panel. I currently work as UN Resident Coordinator in the Eastern Caribbean, so I will provide mostly a perspective from small island developing states and small states. As you highlighted in your presentation, moderator, there is a very insignificant share of development aid that is really targeting disaster risk reduction. And I can add to this that based on 2018 OECD figures, SEEDS have received only 2% of public climate finance, and 14% was directed only to least developed countries, LDCs. If you look at figures per capita, it's slightly higher. So what I can say based on that is that certainly not enough is allocated to disaster risk reduction and climate finance. Although SEEDS face a unique set of vulnerabilities. They have structural factors, the size, remoteness, exposure to climate risk, natural disasters, vulnerability to socio-economic shocks. And they lack also the economic diversification to face those shocks in addition to high level of debt. So that certainly limits their ability to achieve sustainable development. And when it comes to disasters, the Caribbean is in a way significantly more exposed than other seas with a higher cost to recover. For example, in 2017, the cost of the hurricane season for the Caribbean countries was $25 billion if we include Cuba. So this higher frequency and cost coupled with tight fiscal conditions implies that governments often are forced to respond increasing their debt burdens, hence they end up with less fiscal space. However, on the other hand, concessional financing is unable to bridge on its own the SDG and resilience gap. So the income-based metrics to inform allocations of concessional finance mean that many upper middle-income countries or high-income countries like in the Caribbean are further limited from accessing this concessional financing. So why the debate on going beyond GDP and is extremely important in that context, as well as strengthening climate financing through greater access to innovative financing instruments. That's absolutely paramount for this region. My second point is that the financing that is available is often not adapted to the needs of seeds. A common perception in the region, for example, is that climate finance is fragmented, slow, insufficient, and with excessive demands to qualify. For seeds or small states, there is often capacity gaps, small public administration to develop compelling business cases. And this is often complexified by the plethora of funding instruments that exist out there. So in this context, smaller countries tend to prefer budget support or similar instruments with lower transaction costs, which have fewer compliance and greater flexibility to address resilience. But the problem is that those funding sources are certainly not enough to build the resilience that is required. My third point is that financing needs to be coupled with capacity building and an enabling environment. And as much as there is a need for increased allocation and more effective financing instrument, there is also an equal need to couple financing with analysis, data, capacity building to support a conducive national environment, build portfolio of investable projects, for example, and of course capacities to implement them. So this is a challenge for seeds and LDCs that is certainly as big as the access to financing itself. And this, of course, tends to increase the perception of greater risk for investors. But to bridge the resilience gap, countries will certainly need to attract finance from other non-traditional sources, such as social impact investment and blended finance. So, in a way, government needs support for the development of this conducive enabling environment to facilitate the development of those financing instruments, but also to develop beyond the concept phase this pipeline of investable project. And I want to mention that integrated national financing framework can really enhance this enabling environment, including for innovative financing. This is an approach that we strongly support as United Nations, of course. We currently have 3 INFF that will be conducted in 3 Eastern Caribbean countries with a focus on blue economy and resilience building with agencies such as UNDP, FAO, and UN Environment Program. And that, if you can really help scale up financing initiatives and existing resilience building capital platform. My fourth and last point is that there is a need to invest in people's resilience as much as in resilient infrastructure, and that's certainly a lesson that we have learned from COVID. And that's why adaptive social protection is an example that has worked with dedicated investment during the crisis when those resources were allocated. But current financing models do not necessarily focus on people's resilience, or it must be done at the cost of fiscal imbalances that are in the end unsustainable. So governments are often forced between choosing and servicing the debt or servicing the people. And when I see that around, I think 4 countries in the Caribbean have around 50% of government income more, for one, that are allocated for servicing total debt, I think that we cannot dissociate the debate on financing resilience from the debt issue. And I'll stop here.
Okay, thank you, Mr. Trebuch. My next question should be to Dr. Charlotte Benson. We know that ADB is a key partner in the Asia-Pacific region to help countries get access to financing prevention. Yet the scale of what is required is great, immense. What barriers need to be removed according to you, Dr. Benson?
Thank you first very much for the invitation for ADB to join this panel. It's a real pleasure to be here. The scale of financing is certainly immense. I think in answering the question, though, it's important to make a distinction between investments that integrate risk reduction measures. So, for instance, road projects that include slope stabilization works to reduce the risk of landslides. And then second, investments whose specific purpose is to increase resilience. For that first category, I don't think countries necessarily need access to dedicated financing for prevention, but there are actions that we can take to remove barriers to meeting the financing needs. So with some overlap between what Didier said, for instance, we need to build the evidence available to all investors, public and private, regarding the potential net returns and the impact of resilient design features. We need to ensure the availability and the accessibility of risk information at sufficient levels of resolution to fully assess risk and design appropriate solutions. Ideally, we also need area-wide, say city-wide, climate and disaster risk assessments to inform physical planning and address cascading risks and the possibility of stranded assets. We need to get across the message that costs of achieving resilience are not necessarily prohibitive. We need to get much better at seeking out ways of reducing those costs, though, in particular by integrating those risk assessments into upstream early stage planning of investments, building resilience in as a core principle from the very beginning. And of course, we need to ensure that all of this is complemented by risk sensitive regulations and standards. Turning now to that second category, these include both investments directly addressing risk, such as flood risk management and coastal protection projects, and also investments focusing on retrofitting to address existing risks. So for instance, school earthquake retrofitting programs. Here we hit an innate barrier along the lines of bankable projects. So that is that investors want relatively near-term positive streams of revenue for their investments, yet disaster risk reduction and climate change adaptation investments avoid negative flows of income at indeterminate dates in the future instead. On a positive note, some investments in resilience can indeed also generate positive streams of income and so can attract private investment. So for instance, investments in smart agriculture, such as drip irrigation. There are also opportunities around land value capture, effectively monetizing the increase in land value and property prices as a result of risk reduction investments. But there's really no getting away from the fact that governments and development partners will have to finance a significant share of resilience investments given their public good nature. And that to do so, they may need dedicated funding lines, given the natural tendency in allocating general budget resources to focus on the most immediately pressing needs, delivering relatively quick results. So recognizing this, since 2017, ADB, for instance, has earmarked some of its grant resources specifically for investments in disaster and climate resilience. There are, of course, also the considerable global climate change funds, although we must remember that these funds in turn have their own associated barriers that need to be addressed, not least regarding the capacity of developing countries to access them. So, countries need to complete the accreditation process, meeting related fiduciary, safeguard, and other standards. Then there's the time-consuming process of preparing a strong proposal. And then during implementation, of course, governments have to meet the specific data collection, monitoring, and reporting requirements of the relevant fund. As one of the ways around these barriers, these issues, international organizations are supporting governments to access climate funds. So for instance, ADB was one of the first multilateral development banks to become an accredited entity to the Green Climate Fund, GCF, back in 2015. And since then has worked with governments to develop proposals and support project implementation. So GCF has approved a total funding of almost $1 billion to date for ADB projects, accounting for approximately 10% of total GCF project funding approvals. I am out of time, so I will end on that note. Thank you.
Much, Dr. Benson. My next question, we'll look at the innovators, and then I'll put that question to Mr. Iveson. Mr. Iveson, what sort of innovative model can you see there that can be scaled up and implemented in different contexts if we want to look at the transformative financing option?
Well, thank you, Mr. Moderator, and thank you for accommodating my remote participation. I really wish I could have joined you there in person, because the last time I was in Bali was for COP13 as a young city councilor, and many years later, I've remained committed to climate leadership at the municipal level, even though my elected service is wrapped up. And so proud to be with you as part of Cooperators Insurance Group, working on finding ways to bring private capital in partnership with insurers and governments to build infrastructure in communities that will solve flood issues, heat issues, fire issues, all risks that we see around the world. And in Canada, being a polar nation closer to the north, we've actually seen accelerated exposure to climate change in communities like mine, where we've seen repeated 1 in 100 and 1 in 200 year storm events. communities north of us that have seen devastating forest fires that led to the evacuation of tens of thousands of our neighbors who came and sheltered as refugees in our own country in my city while I was mayor. And so it's in that context that I joined cooperators to try to find solutions to bring private capital to bear. So you may have had a chance to hear from our CEO, Rob Wessling, who attended the conference in person. And he's fond of saying that there is no transition to net zero without resilience. And right now, 93% of the funding going into climate investment is going into transition, and not to reduce that at all, but we need to seriously augment and accelerate our investments in resilience. So as Dr. Benson was indicating, that falls into two categories. There are those asset level investments in resilience. So one tangible example in Canada would be the federal government is working through the new Canadian Infrastructure Bank to deploy a massive scale up of electric vehicle charging stations. Now, clearly that's transition infrastructure. But one of the things that we're interested in and speaking with them about is if that infrastructure is deployed in flood-prone areas, are there resiliency upgrades or modifications to the design that might be pennies on the dollar that would add resilience to those transition investments? And we need to look at that in terms of building materials, roofing, flood-prone areas, elevating critical infrastructure. But another example that we've looked at that's sort of an after-action learning was that all of those windmills in Texas, for example, were spec'd with warm weather gear oil. And if they had been spec'd with slightly more expensive, again, pennies on the dollar, a gear oil capable of handling the colder temperatures during the ice storm there, then they might have been able to continue to get electricity from them when their grid was struggling during the ice storm event. So pricing and resiliency on all our transition assets is something that we need to begin to design for, and may have an investable proposition behind it where it comes to the reliability or uptime of particularly critical infrastructure on the energy side. At the systems level, though, the example I would give you is from my own city, a $1.6 billion flood mitigation strategy for a city of 1 million people that, again, continues to get hit by more and more severe convective storms. And so in the neighborhood I grew up in, 1 in 50-year storm was what it was sized for, but that was just after World War II. That used to be 2 inches of rain. Now it's 2.5. So the scale is changing, and we need to be able to model for that. And we also need to right size that infrastructure. So one of the other things that insurers can do as part of a grand coalition that includes governments and private finance to deploy infrastructure at the scale of these citywide systems level interventions is to size them correctly rather than overbuild them. Because an awful lot of what gets built right now gets built for last year's disaster to maybe a 1 in 1,000 year scale. So we're not seeing efficient allocation of capital, and we're not seeing the kind of deployment of big data to model an optimized infrastructure intervention. It's our theory that bringing private capital and private partnerships to bear, along with government initiative to deploy resilience infrastructure, whether it's around flood or fire or heat, will help right size those investments across a portfolio at the scale of a city or even a watershed or a region or coastal area. So clearly there's a role for the private sector, and insurers and investors in Canada are hoping to lead. And we appreciate UNDRR's partnership and support as we try to design tools that we very intentionally hope will be scalable to the world.
Thank you, Mr. Edon. Let me ask Didier if there is any other innovative model that you see in there that we can add to what Mr. Edon has just said.
Sure. And the first reflection is that when we think about innovative model, I think we also have to first highlight that it is not about just increasing access, but also improving efficiency and effectiveness of existing or new finances, so that we make sure that those models have a greater impact to achieve the Sustainable Development Goals. From the Caribbean region, I think that a lot of good innovations that have taken place in the past year or past decade that I can highlight. And the first one that comes to mind is the Caribbean Catastrophe Risk Insurance Facility. That was the first multi-country risk pool established in 2007 in the world, and it really helps to limit the impact of disasters. It provides quick financial liquidity when the policy is triggered. So it has the advantage of quick disbursement, but it's also quite limited in scope. One innovation recently that has been introduced has been to link this with social protection system, and this has been supported by UN agencies such as the World Food Programme and the International Labour Organization in countries like Dominica and now in Belize, providing some top-ups and to identify new beneficiaries as soon as those policies are triggered. So those type of enabling social protection to become more shock responsive are probably something that can be scaled up. Now, if I move on to the area of innovative bonds, I think that in the Caribbean, we have seen recently Jamaica that has become the first government to sponsor a catastrophe bond in 2021. And that's quite an interesting model because it offers financial protection for several hurricane seasons in the tune, I think, of close to $200 million for 3 hurricane seasons. But one interesting development that have taken place recently is the hurricane clause in debt contract. And it's quite an innovative instrument because that's a mechanism that allows the deferral of payment of both interest and capital in the event of a qualifying disaster. Grenada, for example, restructured its bonds a few years ago by including this clause, and Barbados has similarly taken that initiative as well. So it has the advantage of providing additional fiscal space when a disaster strikes, but there's also been consideration that such clause could be an incentive to increase debt. In addition, there are other instruments in the pipeline, and I think immediately about Caribbean Resilience Fund. This is supported by the UN ECLAC, Regional Economic Commission. The CRF will be anchored into a debt for climate adaptation swaps, and it will provide at the same time debt relief to 3 Eastern Caribbean countries. So that's a mechanism that basically spurs economic recovery, but also increase liquidity in addition to building resilience. And one more that I think of, if I may, is the Blue Investment Facility that is being currently developed to support projects across several Eastern Caribbean countries. And it's really about bolstering disaster resilience, creating a pipeline of bankable projects in the blue economy. It's initially an initiative supported by the UN and the global SDG funds that expects to leverage at least 3 times the initial funding from regional or international private capital investors, with a focus, of course, on de-risking, bringing those initiatives to certain maturity for investment, either in resilient infrastructure or for strengthening sustainable livelihoods or supply chains. Okay. So overall, I would think that financing for disaster resilience, at least in the Caribbean cities, is quite on the right track, but of course much more could and should be done to develop new innovative financing mechanisms. For example, I'm thinking of SDG bonds with resilience to be fully embedded. I think that's really an important pathway for the future. And that's important to help countries, again, to create this enabling environment, both legal, regulatory capacity, with the solution to scale up those existing platforms.
Okay, thank you. Thank you for sharing all these innovative models. We'll definitely come back to it during the Q&A session, and then maybe from the audience we can also have some instances to share. My next question would target policy and now incentive for financing. And my question is directed to Mr. Blair. What policies and incentives do you see for financing should be put in place to meaningfully engage different stakeholders? How do we get the institutional investors, private sector, and the capital market to invest in resilience?
Thank you, moderator, and good afternoon to everyone. I am Tumasi Blair from Antigua and Barbuda, the current chair of AOSIS. And I know it's been quite a while since a question came my way, since we had a good interaction, but I think this question is critically important as it pertains to small island developing states. I think we know that overall investments in SIDS is perhaps the lowest among all groups of countries, and I think Didier pointed out that fact of the percentage of share investments in resilience that goes to different countries, and SIDS are featured at the very end of the spectrum. I think this is mainly due to a few reasons. One would be our population size, and perhaps the lack of sizable return in investments and perceived risk in those investments. So I think one way we could look at this is engaging different stakeholders is to emphasize that investing in resilience is also investing in people. And we must bring this human component to these discussions, and I think Didier pointed out that point also. I think there must also be a more harmonized global framework that provides proper guidelines for financing in resilience. What is critically important, however, are national policies, and therefore these 3 points must be considered in addressing the barriers and providing incentives for financing. One, making localized climate risk and vulnerability data available. And that is crucially important in our discussion today. We know that the limitation of data within small states. As small states and other vulnerable countries, we understand the challenges of data, and we have to find a way of ensuring that we have the relevant data available that could provide an incentive for investments. So what we need an investment in our data, and that investment in our data collection will aid in investment for resilience. Secondly, there must be the creation of effective institutional arrangements for multi-sector adaptation and planning. That is to say, there must be increased articulation of adaptation and resilience goals at the national level, establishing these policies, regulations, and standards, and articulating clear plans, including who will do what, where, when, and how. This will enable institutional investors, private sector, and the capital markets to invest in resilience. And number 3, strengthening financial incentives or reducing risk and cost for private participation through public finance instruments such as blended finance, as we have highlighted before, credit enhancement, and other targeted risk reduction or revenue boosting measures. I think these are some of the possible ways we can increase investments in resilience. And just to quickly add, while I have shared this on the national level, there ought to be similar incentives on the global level with close coordination with our developed partners, the multilateral development banks, and international financial institutions. They must also bring to the table an environment that will enable increased investments in resilience. And I think these could be possible ways in which we can encourage the private sectors and others to start investing in resilience, especially when it comes to small states.
Thank you. Mr. Don Benson, do you have any other thing to share on that aspect of policy and incentive for financing?
Absolutely. As a former elected official, again, it tends to take a disaster to call forth investment in infrastructure or risk mitigation. But again, that tends to only deal with yesterday's disaster. And yet we have better intelligence and modeling capacity out there, both on the public sector and the private sector, and most importantly, in partnership between the two. And this is where I think it should be possible to put a price on inaction. We know conceptually that the benefits of adding resiliency to an economy, a supply chain, a country, a city, far outweigh the costs of disaster, especially when those disasters are predictable and preventable as they are when they arise as a part of climate trends. And so we need to price that in action. And we can't just insure our way through that worsening risk. We actually have to look at mechanisms to say, if we take no action, here is our economic exposure as households, as governments, as businesses, as communities. And if we mitigate that risk, we reduce our exposure to this. And as long as the cost of that intervention is less, then it's a question of harvesting enough of the benefits to make a project bankable. Catastrophe bonds may allow us to do that at the level of a region or a state. TCFD requirements from the Task Force on Climate-Related Financial Disclosures and other movements to require disclosure from local governments, countries, institutions, and publicly traded companies may lead to financial institutions, for example, beginning to look at their lending portfolios and seeing where they have commercial or residential financing that is at risk because there are unmanaged flood risks, for example, or fire risks that jeopardize the underlying assets. And so that begins to motivate intervention and investment on the part of insurers, lenders, and governments. And then fundamentally at the more micro level, you've got tangible examples of, in Canada here, thanks to the Intact Center on Climate Adaptation, some really good study of what happens to property values in repeatedly flood ravaged communities, which is to say, anywhere from a 3 to 20% reduction in property values relative to other parts of the same community and real estate market that aren't exposed to that flood risk. And so that is also a delta that is primarily of interest to a homeowner whose asset is literally underwater in some cases, both financially and materially. And so it's in their interest to look at a strategy to perhaps protect that community differently with a dike or a levee or a low impact development, nature-based solution upstream that reduces the likelihood of flooding. And if that can materially de-risk that community, there's at least two benefits starting to materialize on the private side. One is higher property values, and things like tax increment financing can be brought to bear, perhaps to fund and finance that infrastructure risk mitigation. And then there's also the potential that if they're able to access overland flood insurance today, that those premiums might go down, and that there would then be an interest for the insurers if you can find a way to syndicate a partnership among them around this in a way that's not anti-competitive, some way to bring insurers to bear to harvest some of that delta, because you're also de-risking the insurers and the reinsurers. So the key is to find those deltas either at the macro level or at the more sort of almost neighborhood level, and then harvest those in a way that can fund financing for whatever the infrastructure intervention is. So the key is to get the pricing signals correct. And then there may be some other mechanisms that are required to support collaboration between public and private agencies. Public-private partnerships may allow for that, particularly where there's sophisticated data sharing between public and private risk managers to try to determine the right size of infrastructure intervention for an efficient allocation of capital. That may be proprietary, but it may also be possible to structure those partnerships in an open sourced way. Cooperators is itself a cooperative and part of the a leader in the cooperative movement in Canada, and it may be possible to structure some of these projects as cooperatives as well, with multi-stakeholder participation, public and private, that is transparent and operates on a model of risk transfer across public and private balance sheets that's sort of understood by all the stakeholders. And again, conceptually, we know that these investments in resilience will pay off. The key is harvesting enough of the diffuse benefits from reduced disaster mop-up costs for governments and other public agencies down to the level of insurance and property value, and perhaps involving lenders and others who have financial exposure to unmitigated risk, again, which TCFD is requiring all across the board. So as we get disclosure of risk and macro pricing and micro pricing, a financial model will emerge in time. The issue is we don't have a lot of time, and we're behind on resilience as it is. So we have to move fast.
Thank you. Thank you, Mr. Don. Before we open up for questions for the first round of questions, gentlemen, let me have your comment on this question, starting with Didier. How can we ensure that humanitarian development and climate change financing mechanisms support resilience in a more coherent, efficient way, and even more effective manner? Let me have your experience and your perspective on that.
Yeah. Well, thank you, Gerard. I think you put the finger on the right issue, because this is really about bringing coherence between crisis management, DRR, climate action, and financing for development agendas. And that's something that has United Nations systems working, with UNDRR, with the UN country teams and resident coordinators can really help countries with our convening role, coordination, and policy support. So now, thinking through, based on my own experience and in the Caribbean and other parts of the world, I can highlight few thoughts. Firstly, as mentioned before, I think really the finalization and adoption of a multidimensional vulnerability index can really be a key tool to shape policy choices. Because it can improve the distribution of concessional financing, but also link investment in resilience with a risk-informed financing and development strategies. So we fairly believe in this, and we hope that the ongoing process with the high-level panel will result in some useful recommendations. But already, I must say that in the Caribbean Development Bank is a concrete example of this, because they're already using vulnerability as a criterion in their own instrument to distribute their own concessional lending through a sort of NVI as well. And they're also promoting a recovery adjuster to better assess and build resilience capacity amongst its borrowing countries. Okay. The second point I would like to make is about the need to expand regional capital markets. And I think there is a need to work closer together to build coalitions with the private sector, with regional and multilateral development banks, to increase the think resilient approach, I would say, in financial instruments, because that would really provide an increased choice of financing mechanisms from concessional financing to blended finance or social impact investment. Third, I think that linking development and climate finance is really a prerequisite. It's about recasting climate adaptation as somehow a non-discretionary or prerequisite for development itself. And I want to underscore here the importance of the nexus between inequalities, again, social protection and resilience, because climate finance efforts need to be framed also in the context of reducing inequalities, if obviously they are to be effective over the long term. But to make it happen, it is also critical that we address the issue of fragmentation between actors. And I think about IFIs, multilateral agencies, private investors, and financing ecosystem as a whole. I think we can also tap and expand the ESG investment, environmental social governance investment, and responsible banking. Both have enormous potential to direct funds to high impact and high return activities. Criticism for the private sector to invest, there is not enough high return. And we, I think, as global community can support it to gain further momentum. For example, the UN Environment Programme has an initiative around responsible banking that is gaining momentum. Another point that I can make is about, of course, integrating resilience financing with data strengthening, as my colleague Tomasi was mentioning before, but also e-governance, capacity development, digitalization, and digital transition. So enhancing the enabling environment through, among other things, as well, using the INFF to support the development of financing instrument as this could lead, I'm sure, to open up opportunities for blended financing in resilience. And finally, integrated resilience building into disaster response and recovery. I think this is absolutely important because that can ensure that the resources invested build resilience to future shocks. We tend to do this very often from a short-term approach, but it's important to tie this to gender-responsive innovative financing, gender-responsive climate adaptation as well, and digital finance transformation. So we take a sort of true long-term approach when initiating a recovery process.
Okay, merci. Thank you, Didier Trebouc. Thank you very much. Dr. Benson, on the same question, is there any other financial mechanism support for resilience?
Thank you, and I agree. I think this is a really vital question. I'd like to add to that mix. I think we have in the humanitarian development and climate change financing mechanisms. I would also add, building on from the point that Didier's just made, recovery and reconstruction resources. So those resources, development, climate change, adaptation, humanitarian operations, post-disaster, early recovery and reconstruction, those activities don't occur in silos. There's significant complementarity and overlap, not least in terms of objectives and therefore need for coordination, including to ensure that funds are used as efficiently as possible. Humanitarian funds are a bit of an outlier in that traditionally they have focused on core humanitarian needs after a disaster or emergency, so on water, food, shelter, medical attention, and so on. However, as has been, I think, discussed a number of times over the last few days, humanitarian funds are beginning to be drawn on for anticipatory action. That is for disbursement to communities threatened by forecasted events. And those resources then enable communities to take early action ahead of time to save lives, livelihoods, and assets. As such, anticipatory action helps protect development gains as well, and in turn benefits from the use of climate change and development financing to strengthen early warning systems and impact analytics, and so allow those anticipatory action instruments to be established in the first place. Post-disaster recovery and reconstruction efforts also offer opportunities to enhance resilience and to advance development. But to fully reap those opportunities, we need to step up pre-disaster recovery planning, so including to pre-identify potential ways of enhancing resilience after an event and of securing those possible development gains. So for instance, there might be opportunities for upgrades in technology. We also need to ensure that there's timely, assured, adequate flows of financing after disasters to enable those pre-disaster recovery plans to be implemented. And then there are also opportunities to use such instruments to incentivize longer term investment in resilience. So for instance, ADB is providing countries with pre-negotiated contingent disaster financing loans and grants that disperses budget support very rapidly in the aftermath of a disaster, but also come with attached frameworks of action to build long-term resilience. More generally though, how we go about really enhancing coherence, efficiency and effectiveness of the various financing mechanisms isn't easy. Perhaps though a critical step that can be taken across the board is to position increased resilience as a core objective of all forms of financing, not least to ensure that each of them delivers sustainable resilience results. And recognizing the huge complexity of vulnerability to different types of hazard and shock, that notion of resilience should be far-ranging. So not only covering natural hazards and climate change, but epidemics and pandemics, conflict, economic shocks, and should recognize the cascading impacts that shocks can have, not only within, but also beyond directly affected countries. And then linked to that, I think we need to recognize that building resilience is everybody's responsibility. It's not something that can be delegated to units working specifically on disastrous management and climate change adaptation, be they in government or in development partners. And this then kind of takes me back to my earlier comments on the need for risk data, understanding of ways of enhancing resilience, of the benefits of resilience, those resilience indices and so forth, and also the need to ensure that all of that information is accessible right across the board. As a final point, in enhancing coherence, I think at the same time we need to be fully aware of certain limitations in eligible uses of particular sources of funding. So for instance, many countries face both climate risks, so for instance, floods, droughts and so on, and also geophysical risks, so earthquakes, tsunamis, volcanic eruptions. Yet climate financing may not be able to address those geophysical risks. So for instance, a climate fund may be able to finance an upstream citywide climate risk assessment, but not to finance an extension of that assessment to also consider geophysical hazards. And this, of course, flies in the face of recognized good practice to take multi-hazard approaches. Complementary financing could be found, but it's worth remembering that there are far fewer funds focusing on disaster risk reduction. Thank you.
Okay, thank you, Dr. Benson. Mr. Blair, quickly.
Thank you. I'll try to be as quick as possible, but more or less comprehensive during this session. And I think both my fellow panelists made some valid points here. But I think, let us be honest, in our discussions, the environment is chiefly the anchor to resilience building. And so we would see that COVID has taught us that our human and development pillars can be greatly impacted if we do not build a resilient systems. However, there's a direct correlation with the changing climate and the rapid spread of COVID-19. So naturally, as the chair of AOSIS, I want to approach this question from the perspective of climate change. And so there is no climate resilient development for vulnerable countries beyond 1.5 degrees Celsius. And I want to repeat that there is no climate resilient development for vulnerable countries beyond 1.5 degrees Celsius. Exceeding 1.5 degrees will undermine climate resilient development, including surpassing adaptation limits for critical ecosystems and the livelihoods that depend on them. I think the first step towards coherent resilience is therefore aggressive mitigation in line with 1.5 degrees pathway. That means peaking global emissions before 2025 and halving global emissions by 2030. At 2 degrees Celsius, climate resilient development would not be possible for vulnerable countries. This essentially means that it would be expensive for us to address climate change and also build resilience, if we're still around. I think countries must move beyond incremental progress towards transformational adaptation to build resilience. The resounding message from this year's climate reports is that we must deliver nothing short of transformation. That is, to paraphrase the IPCC, transformation and system transitions in energy, coastal and freshwater ecosystems, infrastructure, industry, and society if we are to cope with the onslaught of interconnected climate crisis. So initiatives that prioritize immediate and near-term climate risk reduction reduces the opportunity for transformational adaptation. So transformational adaptational actions toward resilience means flexible, multi-sectoral, inclusive, and long-term planning and implementation. All decisions at all levels must factor in physical climate risk using different degrees and stress testing, and at longer-term horizons. So I think we need reformed financing mechanisms that support transformation. The financing mechanisms program support through projects which are assessed based on short-term return on investment. There are some examples from SIDS where projects cut out ecosystem-based coastal actions because the return on investments could not be quantified. The project takes an average of 12 to 12 months, by which time the needs on the ground have shifted. And I'll give an example on what I'm referring to here. In 2015, Antigua and Barbuda was hit by a devastating hurricane. And up until today, the sister island of Barbuda has not recovered. And while we have had pledges in building our resilience and addressing the devastation in Barbuda, we are now almost 5 or 7 years later, and Barbuda has still not rebuilt. And we're now approaching another hurricane season. And it simply means that we have not addressed the resilience there. We have not adequately provided the necessary finance to build the resilience. And it simply means that if another hurricane strikes the sister island of Barbuda, then the devastation would be even worse. I think climate vulnerable countries need more flexible and pragmatic financing. And this can be achieved by 3 things. Capitalizing the climate funds with at least $1 billion per year in small-scale finance that is easily accessed by local civil society and micro, small, and medium businesses. 2, debt for climate financing, and I think Didier had pointed to this. So debt for climate financing to create physical space with agreements that the restructured debt would be programmed into resilience measures. And Antigua and Barbuda, as Didier had pointed out, and 2 other OECS countries are embarking on a debt for climate swap initiative. And finally, we need risk insurance. And this is critical for us in ensuring that we have the necessary financing to build our resilience. Thank you.
Okay, thank you very much. Now is Q&A session. Ladies and gentlemen, let's have the audience engage with you guys on some of the issues we have been discussing so far. Allow me to relay one or two questions from the online platform before we can come to the audience for those who are in the room here. And the first question now, I'll put it to Mr. Didier. Climate finance is primarily designed toward addressing climate-related hazards. Now, the question is, how do we finance prevention action for non-climate hazard? Because we are talking about transformative financing option. Now, how do we finance prevention action for non-climate hazard? That's a question for you.
Yeah. Well, I think the key to this is to have a multi-hazard approach to financing resilience. I don't think we can work in silo again. Building resilience into development planning, having risk-informed financing strategy means that, of course, we need to access financing for reducing risk, whether the disaster is provoked by actions or climate action. So the importance also is to, in my view, I don't have necessarily all the technical answers to this, but to diversify the financing sources. And there is domestic resources, but there is also the need to increase reliance on private financing. And I think perhaps our colleague from ADB can further elaborate on this. Attracting investment from private sector is, in my view, extremely key to build this most needed resilience, whether the origin of the risk and the hazard is climate related or non-climate related. And I think that the COVID crisis has proven once again and given us a lot of lessons that we need to be better prepared, invest on the health preparedness system, invest in social protection, but also invest in people's resilience so that we make sure that people are resilient both to climate-related impact or non-climate related impact.
Let's ask Mr. Don, do you have any ideas for financing a prevention action for non-climate hazard, Mr. Don?
Particularly on the west coast of Canada, related to earthquakes, for example, and there may be strategies related to mitigation or even just preparedness, structural upgrades to homes and so on and so forth that protect their residual value. So it's some of the same risk modeling I was mentioning earlier that is maybe particularly relevant to lenders who hold mortgages on those properties, as well as the insurers who provide insurance that is expected by those lenders to protect those properties. The challenge is that the structure is insured, but the land isn't. So when you get into risks related to earthquake, for example, like soil liquefaction, the soil becoming unstable and obviously impairing the structure makes both assets, the structure and the land, potentially worthless. And so so there's examples related to earthquake, and then there are other hazards related to sea level rise that are climate related but are distinct from overland flooding and storm related damage, where there's also some intersection. So I think that there and this is where, again, bringing insurers to the table is wise, to the extent that there are multiple hazards presenting, to say nothing of the social unrest and income inequality and other challenges that make all of this more complicated. So certainly, I think involving insurers is one of the best ways to make sure that all the hazards are on the table, so that they can be prioritized. And the 2-for-1s and the 3-for-1s of transition and multiple risk mitigation can be attacked simultaneously with some efficiency on a portfolio basis.
On the same question.
Sure, thank you. And so how do we invest in non-climate hazards?
Yeah.
And I want to approach this from a different perspective. I think we cannot divorce the impact of climate change and building resilience from non-hazard climate effects on small states in particular. And this is where I wanted to come in. Because what we would notice is that if we had enough resources, we would be able to build our resilience both on climate change and also on non-climate hazards. And COVID-19 has taught us this lesson. And because of climate change, most of our countries, especially small states, are highly indebted countries now. And so one avenue, at least, that we would want to explore is whether or not there's an opportunity for debt forgiveness, and debt forgiveness based on the impact that climate change have had on our small states. And if there's an opportunity for us to clear these past debt, it simply means that there would be enough liquidity in our countries to build resilience to non-climate hazards. And so I think this conversation also needs to take into account the effects that climate change have had on the debt portfolios of small states and our ability to address other non-climate related hazards. Then additionally, there must be the input from developed partners in this conversation. It cannot be for small states just us trying to build our resilience alone. We do not have a large private sector in small states at all. So while we would want to look at the private sector for some input in building our resilience, we cannot depend on the private sector. It's just too small. We don't have the scale of private sector. So we do need our developed partners to come on board. And one way that they can come on board is to live up to their commitment on ODA. That's crucially important for us. There are only few developed countries that have really achieved their commitment on ODA, and so committing or recommitting to ODA would also allow us to address non-climate hazards.
Okay, thank you. Let me take one more question from the platform, and then I'll give you the floor. And my next question is for Dr. Benson. What, in your mind, are the enabling factors for accelerating the allocation of financial resources to building resilience? Dr. Charlotte.
Thank you very much for that question. So what are the enabling factors for accelerating, financing for resilience? So I think it partly, very briefly, comes back to a better understanding of the scale of the issues, the level of risk that we face across many different sectors, across communities, and so on. And beginning at that starting point by building the understanding of the implications, the impacts, potential impacts of those risks, and then the solutions that can be put in place to address them, and to explore ways of maintaining relatively low costs in achieving those solutions. I think we have actually come a long way on one level. I mean, financing for disaster risk reduction, of itself remains very difficult to obtain. But I think there is increasing recognition of the overlap of issues across these different funding streams, that risk reduction is a core aspect in achieving sustainable development, that there are very significant crossovers with climate change as well, and that that is certainly increasing the financing availability. One thing we do still need to do is, of course, to address the huge imbalance between resources available for disaster response versus disaster risk reduction, specifically within the disaster risk management domain. We've heard figures on this already. There has been a huge amount of innovation over recent years in terms of insurance, but that's still ultimately dealing with financing to address events after they happen, and we need to put much more focus on risk reduction. As it happens, that huge progress around insurance has got major benefits because it has led to significant development of risk models, quantification of disaster risk, and we can feed that into the case for risk reduction as well, and therefore build the case for greater financing allocations in this area. Thank you.
Okay, thank you very much. We only have 20 minutes left for this session, but I'll take 2 or 3 questions maximum from the audience. Yes, the gentleman out there for the first question. Thank you.
Yeah, thank you, Gerard. My name is Demetrio Innocenti. I'm working for the Green Climate Fund. And last week, and I want to thank the government of Antigua and Barbuda that hosted the board meeting of the fund. So I was there, and indeed we had the occasion with some representative of the government to talk about this debt for climate swaps. My question to all of you, if there are already experience of such innovative financing measures in the Caribbean and the Pacific, so the question also to Charlie Benson. And my question to Don is another elements that emerged in some conversations I had in Antigua, which, I mean, they noted this fact that, you know, we invest to make our houses more resilient to climate hazards, and this increase the value of the house, and this make us paying higher premium for the insurances. So there is no incentive for us to take risk reduction measures, or there is no incentive for us to pay higher premium for insurance. So the question to Don is if there is a solution to this, and if this is also the case in other countries in which if you take risk reduction measures, you end up paying more your insurance premium. Thanks.
Okay, I'll take the, yes, not the gentleman then, and then you, please. Oh.
Thank you so much. I am from, my name is Mami from Madagascar. As Madagascar is the country very vulnerable of the tropical cyclone and drought, so we already use this insurance mechanism for the drought. So we already received also the first premium, the disbursement for the drought, and this year we received also the $10 million for the premium from the disbursement from this cyclone after this cyclone season. But until now, so we received that the what is that subvention from the donors. So that is only the pilot project. So my question is how to have the sustainable financement and investment in order to continue this insurance mechanism that we evaluate an important mechanism in the country like Madagascar, suffer with cyclone and drought every year. The second one is for the collaboration between private sector and the public agency. So how to attract the private sector, because after the COVID-19, so the private sector is have big problem for the investment. So all activities stopped, and when you try to collaborate with us, so they think that we come to request again the financement. So is it possible how to have the what is the subvention from the private sector? Thank you so much.
Thank you very much. Yes, the gentleman and the lady, and then we will answer that round of questions first. Yeah.
Yeah, thank you very much. My name is Matthias Ranger. I'm head of risk finance and insurance at GIZ. Short question, hope the answer will be a bit longer. Do you expect that the development and the implementation of sustainable finance taxonomies will increase the shift of the financial flows into resilience on a local level.
Okay, thank you. And the last one before.
Thank you very much, Mr. Moderator. So, Indonesia used to have kind of like special allocation for the disaster, and then we do that, so we call it reactive action. So every time there's disaster, and then we have a program, but we have this weakness that sometimes the allocation is not enough. So we have to sift the money from the economic purpose, so it's delay our growth. And then even we have a program to help the disaster, actually the program sometimes is not matched that what with the victims need. So we create this pooling fund, we create the business model that the purpose is to be independent from the national budget, and then we have target for the pooling fund for the disaster that will be independently, not gonna affect our national budget by 2030.
Okay, thank you. We have
hold on.
Oh.
So my question is, the obstacle that we have actually is a lot. So, and then in here, actually we ask the international community, what is the right business model? What is the right institutional and legal framework for this? And how, to measure like risk distribution in to make our pooling fund actually effective and we can achieve our goal in the future. And then actually,
Please.
And how to seek the invite the private sector to come here, but we also have this knowledge transfer from the private sector to be, you mentioned about the capacity building, so to make the country also understand to develop the concept.
Thank you. Thank you very much. I'll give 2 minutes to each of my panelists. You can, starting with Mr. Don, you can just take any of the questions that you feel much more interested in, and let's go.
Great, thank you for the questions. On the first one, I may have misspoken. In the model where a dike or a levee improves property values by protecting a flood-prone area, the property values would go up, and so potentially the property taxes paid to a local government associated with that property might also rise. So a fee would increase, but that would be the new cash flow that might pay for some or all of the infrastructure. If an additional amount was needed, that might be harvested in a delta between the insurance premiums without risk mitigation versus what the insurance premiums would be with risk mitigation, which should be lower. So if I misspoke, your insurance should get cheaper all around the world if we reduce our collective risks. And I think Dr. Benson put it really well, that we can't just pass the risk around differently. We have to fundamentally prevent it and move into very, very dramatic risk mitigation mode through a variety of measures, which are in Canada alone will be tens, if not hundreds of billions of dollars worth of infrastructure investment to deal with water, to deal with fire, to deal with heat in our cities, and extrapolate those numbers around the world. But if we do all of those things, the risks of those losses should be less. And so the premiums to cover those for insurers and reinsurers should be lower over time. And the difference there is one of the things that we may be able to harvest to fund some of this infrastructure. And the other question was, and I'll answer it really quickly, will sustainable finance taxonomies drive investment at the local level? In theory, yes. TCFD requirements for all local governments would go a long way to require this risk disclosure, building on the work of the Resilient Cities Network and ICLEI Local Governments for Sustainability's BARC program, for example. So short answer is yes. It would drive the right pricing signals through the right risk disclosures.
Thank you very much, Mr. Blake. 2 minutes, please.
Thank you. Sure. I will attempt the question from Madagascar, I think he's from, where he spoke on the issue regarding insurance. And Antigua and Barbuda faces a similar issue. Years before, when we had insurance premium and we were hit by a natural disaster, a hurricane in particular, and the premium payout was less, of course, than the damage that was caused. And I think one way that we we sought to approach this within the Caribbean region is this pool insurance fund. And I think that's one way that at least Madagascar and the surrounding countries can try to address this, is to trying to have a regional or sub-regional pooling system within the insurance. I think that would drive down your premium cost, but also would lend for a greater payout. I think also we have to be unified as developing countries and approach this from a pragmatic matter. And you would be aware of the conversations that are ongoing regarding loss and damage, all right? And I think this is an important component in how we try to address the issues based on damages from climate change. And so we should continue to push for loss and for the establishment of a loss and damage mechanism, where resources will be poured into this mechanism, and then countries, developing countries in particular, the most vulnerable countries, would then benefit from such a mechanism.
Okay. Dr. Benson, would you address the issue about independent financing that has been raised here, please?
Sorry, which question? I was going to address, if I may, briefly the question on debt climate swaps. I don't think anyone's addressed that one yet. Just to say, though, I think the Caribbean is ahead of the Pacific in this regard. UN SCAP released a study earlier this year on their application in the Pacific, but as far as I know, that instrument is not as yet being used in that part of the world. Briefly also on Indonesia, if I may, I can't comment on the intricacies of the risk pooling fund that's being established, but I mean, broadly speaking, in building financing for disaster response, the good practice approach is to follow a layered approach, recognizing that countries face a range of types of hazard, and that those hazards in turn occur with varying frequencies of occurrence and therefore intensity. And there are different types of financing instrument better matched to these different frequencies of events. So for events that happen very, very frequently, obviously you begin with risk reduction, but you will have some residual risk. And at that point, you'd be looking at risk retention instruments that keep that risk on government books. So for instance, contingent funds, annual allocations for contingent budgets, perhaps reserves over time. You then move on to that layer of less frequent events, but ones which have a more severe impact. And they're often the most cost-efficient instrument is risk transfer, obviously including insurance, and also at the higher end insurance-linked securities such as cat bonds. And then, of course, in the case of a very major event, the international community also steps in, including with grants. I think it's important to remember there are very high opportunity costs, of course, in allocating a lot of government-owned resources and putting them aside in case of an event. And also, if the long-run insurance, you pay more out in premiums than you get back. So there's no country that has fully prepared ahead of time financially for every eventuality. There will always be, in the case of a really major event, some reallocation of budget resources, some delay in development plans, and so on. Thank you.
Okay, thank you very much. This session is of great interest, and as you can see, I wish we can take much more questions, but we are running definitely out of time. I'll give now the last 2 minutes to each panelist, and that will be your key conclusion points, that will be the takeaways that we're going to take out of this. Yes. They will address it, surely, that your question is still unanswered. Let's see the way forwards in terms of having the possibility of more transformative financing option to build a more effective and sustainable resilience. Didier, over to you.
Yeah, well, generally, I think that session was interesting because there is huge potential, and we are at a turning point 7 years before achieving the SDGs or the Sendai Framework. So I think we really have to rethink how the financing systems are built, make sure that the public and financial sectors are really risk-proof if we're really serious about the Agenda 2030 and the Sendai Framework. So I really hope that the midterm review will come up with some good conclusion and recommendation in that regard. I was in a ministerial roundtable earlier, and really there was this call for greater collaboration with regional and global levels, and a call to step up in cooperation for the most vulnerable. So I think this should be the driver for the financing of resilience. For example, we know that people living in least developed countries or seeds are 15 times more likely to die from a climate impact, or still 1 out of 3 persons do not have access to early warning systems. So I think there is really room to improve the financing, targeting it properly to the most vulnerable and to those gaps that are not yet covered.
Thank you. Dr. Charlotte, any conclusion point?
Sure, thank you. And first, thanks very much for the really rich discussion and the great questions. I'd like to make 2 final points, if I may. First, I'd like to reiterate my earlier comment that we need to position increased resilience as a core objective of all investments, public and private, and that we need to design those investments from their very inception with that resilience goal in mind. In doing so, of course, armed with all the necessary risk information and seeking to explore opportunities to keep costs down. Second, we need to remember it's not just a question of securing adequate financing for resilience. We also need to ensure that the financing reaches priority investments, reflecting people-centered priorities, not just bankable projects. And then linked to that from a public sector perspective, we need to ensure that financing reaches the relevant government agencies charged with related responsibilities. As such, we need to ensure that resilience responsibilities are clearly and fully articulated across all relevant government agencies, including local government. We need to ensure that those government agencies have the capacity to deliver on their responsibilities, including to develop and implement projects that enhance resilience or build in resilience measures. And we need to ensure that those government agencies then have that necessary financing to do so. In reality, there are sometimes very significant mismatches, particularly at the local level, between, on the one hand, assigned responsibilities, and on the other, both capacity to deliver on them and access to the required financing. And we urgently need to address this. Thank you.
Okay, Mr. Blair, what will you say? Conclusion to this session?
I think the way that previous panelists ended her intervention, the direction that I wanted to go is on access to finance. And I think this is critical if we are looking at building resilience. And so as AUSIS, we are now engaging in the process of the development of a multi-dimensional vulnerability index. And this index could achieve exactly what we're discussing today, the need to access finance and building resilience. And so by accessing this financing, vulnerable countries in particular will be able to build their own resilience. And I think one of the key messages that we want to take away from the discussions on the MVI is that majority of developing countries are locked out from concessional financing because they have graduated into this middle or high income status. And with the MVI coming on board, hopefully adopted at the end of this year, this will allow almost all states to access the necessary financings that they would need to continue to build their resilience. So I hope that the takeaway message from here is to impress upon your governments and different stakeholders that this MVI should be adopted and should be available for all developing countries.
Thank you, Mr. Blair. Mr. Don Iverson, would you have any point as a conclusion for this session?
Sure, great discussion. And the issue is that uninsured losses are rising everywhere for a couple of reasons. The fundamental risks are rising in nonlinear ways, which is difficult for us to conceive, but all the more reason for us to have good modeling to predict those risks and make scenario-based decisions about managing them effectively. Because right now, insurance is either unavailable or unaffordable. In the cases where it is unavailable, that is essentially a market failure. And that is now borne at the level of a subnational government or a national government or a region of governments who are struck by a major national disaster or natural disaster. And that is just socialized risk. That is mutual insurance at the level of the state, and that drives debt and unsustainable financial conditions for communities who can hardly afford it. And that is even the case in a country as prosperous as Canada. And so I think it's very important to situate in a global context that that system is not working anywhere. And I hear loud and clear that it is not working in the global south. And so finding a way that works in all parts of the world to effectively price those unmitigated risks, and then find the opportunities to not simply make insurance affordable and ubiquitous, but actually control that risk is what we need to do in a systematic and portfolio based way. So that is the role for insurers, and in essence it's enlightened self-interest, not because climate change actually just drives more business for insurers where people can afford insurance, but as risk goes up, insurance becomes less affordable, less available, and then you can't de-risk those parts of your economy that depend on insurance to manage risk. And that breaks down the resilience of our economy precisely when we need all of its mechanisms to achieve the investment necessary to manage climate risk, and to do so in an inclusive and equitable way around the world.
Thank you very much. Thank you to all my panelists. I want to thank you, ladies and gentlemen, for coming. It was great having this discussion. I know that you continue discussing through the different networking panel put in place by the GPDRR, and then we hope that this session has been useful to most of you, and then have a great evening, and see you soon. Thank you.